When tracking the smart money, investors usually look for massive cash deployments, but Palantir is taking a different approach to the physical infrastructure market. They are acquiring equity in emerging companies by using their own software as the currency. On July 1, 2026, Alex Karp and Palantir disclosed a 7.4% ownership stake in Surf Air Mobility, a company developing electric aviation technology. This move functions like a venture capital play. By trading software licenses for shares, Palantir is effectively printing its own money to buy into the future transportation grid. The discovery stems from a Schedule 13G filed with the SEC, which disclosed an 8.2 million share stake. While it looks like an open market cash purchase, the underlying filings tell a more complex story. A prospectus supplement reveals that over 4.7 million of those shares were acquired as non-cash consideration. These shares were issued specifically to cover Palantir's licensing fees and professional services. In plain terms, Palantir is trading access to its Foundry and AIP platforms for a permanent ownership stake in the client. The target, Surf Air Mobility, is developing Surf OS, an operating system intended to automate and digitize the fragmented private aviation market. In Hawaii, Surf Air is currently running an electric aircraft demonstration program with Hawaiian Airlines and Beta Technologies to test the logistics for regional cargo and passenger flights. The technological integration is total. Surf OS is built on top of Palantir's architecture, using Foundry and AIP to manage flight scheduling, broker workflows, and predictive maintenance. By embedding its software into these core operations, Palantir makes its platform difficult to replace. This provides a blueprint for how Palantir can integrate its AI into the broader regional aviation infrastructure as it matures. This raises a critical question. Surf Air Mobility is a high-risk microcap that recently restructured $27 million in debt. Why would a cash-rich titan like Palantir accept equity instead of cash from a struggling startup? This risk table illustrates the deal's asymmetry. If the startup fails, Palantir loses the marginal cost of computing power and software licenses. If Surf Air scales, Palantir captures its 7.4% equity upside while locking in a dependent, lifelong customer. This model allows Palantir to subsidize its own client's survival and expand its market reach with very limited capital risk. For retail investors, mirroring this trade by buying SRFM stock carries high risk. The sector is crowded with competitors like Joby and Archer, and the threat of future share dilution remains high for microcap shareholders. A more risk-defined strategy involves focusing on Palantir itself. Using long-dated LEAP call options allows participation in Palantir's commercial expansion while strictly defining the downside. The AI revolution is moving beyond software code. Tech leaders are now using their platforms as leverage to buy into physical infrastructure, one equity stake at a time.